Hello, in conjunction with Bravo Programs of America, I'd like to present a tutorial on FICO score basics. My name is Krystal Pedersen, and I'm a supporter of Bravo Programs of America. I do have a presentation to go with this, so I'll go ahead and share my screen here. So let's see. One second. All right. So with that being said, what is a FICO score? If people hear FICO score or credit score, and really the FICO score is just it's one of the places that is reported. So FICO score was a type of credit score reported created by the Fair Isaac Corporation. So that's actually what it stands for, is Fair Isaac Corporation. Um, Again, it's a type of credit score, but not all credit scores are FICO scores. There are multiple companies that might report a credit score. FICO is just one of them, and it's a very widely known used brand or model for it. But to give an answer, a FICO score or credit score is basically a number from 300 to 850 that summarizes your credit worthiness or how likely you are to repay borrowed money. So what makes up your FICO score is there are a bunch of different percentages, but the biggest one is payment history at 35%. You'll see it in that teal area right there. Amounts owed is 30% of it. The length of your credit history is 15%. And then we have two that are the same at 10% as new credit and credit mix. So to start with it, payment history, the biggest portion here, is basically whether or not you've paid your credit accounts on time. So on-time payments for your credit, that can be a credit card, loan, bills, all of those kind of things. On-time payments are a positive impact to your score. Late payments are a negative impact. So paying any bills that are due at all from taxes and anything that's on public record as well, those are all impact, they can all impact your score. Missed payments, not paying it entirely can really, really damage your score. Um, so one thing I do say is catch up quickly if you miss a payment. And as soon as you notice, try to get it paid because the shorter you repay that, the better it's going to be and the less of a negative essentially you're going to get. Bankruptcies or foreclosures can have a really negative impact, sometimes being on your report for years. That's basically like where you've determined you can't make that payment back ever, and you're just wiping your slate clean. While that can be a good option for some, if you can avoid that and pay it back, that's always the better choice. Um, Public records and judgments, so again, taxes, all of those kind of things. Um, and again, how late your payment is can have a significant impact on that. So with that being said, some tips: pay your bills on time, set up auto pay. Auto pay is a great way to make sure that you're not missing your due dates. You can always pick the same day of each month. It can be after you get paid each time. So that way it's, pulling out and you always know it's paid on time. Also, again, catch up quickly and monitor your credit report for any errors or disputes. Sometimes you might have somebody steal your card number, or there might be a hacker that gets in your account. All of those things, it's important like, to review your bank account, but also the credit report. You can usually see your FICO report through your bank app. Most bank apps have it as an option. But otherwise, there are other places you can find your credit score, your FICO score as well that we'll go over. So, the second biggest portion of your FICO score is amounts owed. So this is basically the amount of debt you currently owe across all of your credit accounts. So it's normally referenced as credit utilization. Now, that is basically the percentage of your total credit limits. So, for example, if you have $1,000 credit limit and you have a $300 balance on that credit card, that means your utilization is 30%. The lower that percentage is, the better. Most experts recommend to have below a 30% utilization, especially on credit cards. So, with that being said, again, it adds up credit cards, loans, mortgages. The number of accounts with balances on them can also affect it. So, for example, two credit cards with balances on it might not be too bad, but the more you start to get really past three, so if you've got 10 credit cards and they're all at 10%, that's actually worse than having like one credit card with 20%. So it's not good to have a bunch of different cards with balances. It's better to keep that a small number. Um, Also, how much you owe on installment loans. So auto and student loans can have an impact as well, but less than credit card utilization. It's not something that you're going to be able to control. If you need a loan to get a car or you need a student loan, it's not going to be something you can control. And we'll actually go over more of how that can actually help your credit score in some situations or your FICO score. Um, some tips on how to improve that owed factor balance portion is to pay down your credit card balances as soon as you can. So if you've got a bunch of cards with payments on it, or even if you have one big, pay those down as soon as possible to zero. Um, Try to keep it below 30%. Avoid ever maxing out your credit card. So what that means is if you've got $1,000 that you can use, don't ever put $999 on that credit card. I don't recommend that. Um, don't ever max that out. Even if you pay it off immediately, it's better to keep that amount lower. So also, if you have an old unused credit card, don't close it out completely because with it being at zero, that can actually help your available credit. So don't close out an old unused credit card. Even if you're not using it, don't cancel it. Also, make more than the minimum payment to reduce your balance. And again, paying it down to zero is definitely better for your FICO score than keeping it at 30%. So paying it off in full. Um, Now there's so many different ways of doing it, and there's a few myths around how to best pay it off or paying it off immediately. It's actually better for your credit to pay it off immediately. Like if you charge your card and then you pay it off right after, that's actually better than if you keep a revolving balance. So what that means is, let's say you put $500 on your card and you've got a total of 1,500. You pay down $200 of it during the month, but then you add it back. That's still the same percentage. So keeping that revolving balance and 30% at the end of each month can actually be worse for your credit than paying it down. It's better to get it down to zero. Um, so again, carrying a balance on it doesn't actually help your credit score. So, some myths are put it at $500 and then pay down $100 each month. It's actually the sooner you pay it off, after it's recorded. So after your statement is the best way to do it. So it's a little complicated, but each month you have a statement basically showing everything that you've purchased in the month with the credit card. And once you get that statement, you'll also have a due date a couple weeks later. If you pay the amount in full after you've received that statement, but before the due date, that's actually the best way to increase your credit and the fastest way of doing it. Um, Again, if you're able to keep the utilization even below 10%, that's even better. So a best way to do that, if you're looking to get like a new credit card, or the best way to use it to increase your credit as fast as possible, pick a bill that you pay every single month, the same amount. So for example, like your auto insurance bill or your phone bill, or something that's not going to vary a lot, and set it up on automatic payments. You can actually you can put the credit card on auto pay to pay that bill, and you can set your bank account to automatically pay the credit card bill each and every month. So that way you don't have to even review the statement each month. You just know it's going to be paid off. You should still review that if your bill ever changes, but setting up auto pay can be a really great way of building that credit without having to stress too much about it. But again, don't max off your card, even if you pay it off immediately. And using your card regularly but lightly is better. So using it each and every month again, or using it for one bill can really help. So what happens if you do buy something and then pay it off immediately. So that can actually still help build your credit, but in a lot of times it will help build it slower because what's reported to your FICO score is that you have a zero balance on the card. And if it's always being reported that you have a zero balance on that statement, then it's not going to increase your credit card. It's not going to increase your FICO score as much as it would if it's reported $10 and then you pay it off and it's zero, for example. So it's much better to pay it after the statement closes, but before the due date that the payment is due in full. So the next portion here is the length of your credit history. So this is 15% of your FICO score here, and this reflects how long you've been using the credit for. So, and this basically determines your reliability and how long you can keep an account open. So, the longer you've had credit, the more data that lenders have, and the more they can assess your risk. The shorter your credit history is, the less information they have. So, how do you control that? Keep your old accounts open. Don't close out old credit cards. Um, and avoid opening a bunch of new accounts at once. So having a bunch of new ones at once is it's going to take longer and the average is going to be lower. Also, start building your credit as early as possible. So the sooner you start, the longer, the better of a history you're going to have in the future. Some good ways to do that are sometimes your bank is going to have either student credit cards or credit builder cards. In some cases, you'll use your own money to borrow against. Sometimes you'll give them $500 and you're borrowing against your own money to basically prove that you can do it before having a normal credit card. Or in some cases, they might just have different interest rates or lower amounts that you can pull from. So, but most places do have credit builder cards to help you build that credit without having credit already in place. The next one is new credit at 10%. So new credit includes like recent credit inquiries. So what that means is like applying for a new credit card or a new loan. Also like soft inquiries. So basically if you're checking for an auto loan, you're trying to get a mortgage on a house, you're checking a few different credit cards. If you do all that all at once, that can actually negatively impact your FICO score. It's better to open accounts or even check for your eligibility for them slowly, like one at a time, if possible. So, like one, two credit cards, that's completely fine. But if you can wait to open the second one for even a year later, that's actually going to help quite a bit. So again, don't recommend to open a bunch at once. And if you're trying to save up for an auto loan for a car, or you're trying to you know that you're going to need a loan in the future, it's not always the best to start applying for credit cards or apply for a credit card rate beforehand. You're going to want to spread them out if you can. Also, the time since the most recent one was open. So again, they look back and see when was the most recent one open and how long ago was that. Um, but again, one or two is not going to have a major effect on you long term. But having a bunch in a short period or consistently doing it over years can really add up over time. So, and the last one we have here is credit mix. So the credit mix is the kind of accounts you have. That's basically revolving credit is credit cards, so things you can borrow, pay back, borrow again at your own discretion. And then installment credit are going to be loans with fixed amounts, like your auto loans, mortgages, student loans, personal loans. This matters because lenders want to see that you can responsibly handle multiple kinds of credit. And honestly, most of you guys, if you're students and you have student loans, you already have installment credit, which is actually this again can be a good thing because as long as you're paying it back regularly. And if you add a credit card to that, then you have a really great mix already. Having one of each, like one auto loan, one credit card, is actually a really good thing. Having that different mix. If you have all credit cards or all loans, that can be where it's just not as beneficial. It doesn't necessarily mean it's a bad thing, but it's not as beneficial for your credit. You're not going to be able to grow it as fast. So I guess the biggest takeaway to improve this area is to try to open, if you don't already have a credit card, open one responsibly. Or if you don't have a loan, sometimes that can actually help your credit. I'm not saying go get an auto loan, go get a mortgage or something, but don't be scared to go get one. It's not going to hurt your credit. It may initially just with the different checks and the credit inquiries, but over time, it will actually help your credit if you're paying it back on time. Let's see. So in summary, the best ways to improve your credit score or your FICO score in this case, is to open a credit card responsibly if you don't already have one. Always pay all of your bills on time. And if you have a credit card, if just to start with, choose one bill and set it up for automatic payments and pay that same bill back at the same time each month after your statement comes out, but before the due date. Keep your credit balances low, so don't go over 30% of the total amount you can do, and try to pay that down to zero each and every month. Start building it as early as possible, so get a credit card as soon as possible. They are not a bad thing as if you use them responsibly. Don't close your first account. So if you have a credit card already, or if you have a bunch, maybe don't go closing them all at once, but definitely try to close them. You don't close them if you can for the old ones. Also, pay your credit card balance in full after the monthly statement, like I said, and be patient. It does take time. You're not going to see immediate results when you do one of these things that I'm suggesting. It will take time of being recorded because it's your entire history that they're looking at. So with being somebody who's just starting to build your credit, it can sometimes take a year or two to start to see those results, but be patient, pay your bills on time, and you will eventually see those results. So, but with that being said, thank you. That's the end of my presentation, and take care.